So now that we've touched on the various ways that you can give to a charity directly, let's cover all of them, all in one picture, because we want to talk about all the different ways that you can structure your charitable gifts, and it's really going to depend on what goals you're trying to accomplish. So as a quick reminder, you can either give to a charity while you're alive and enjoy that income tax deduction, which is unfortunately limited depending upon the type of organization you're giving to and the type of gift you're giving. But you can usually carry forward that excess deduction if you happen to blow through the limit. Any gifts that you give at death are still good. You gave to a charity, but it's not going to get the benefit of an income tax deduction. It's simply going to reduce the size of your taxable estate, which is also a good thing if you're trying to reduce your estate taxes. Let's look at all of these different ways that you can give, and some of this is going to be a review. So the most basic form of giving is to give direct to a charity. Salvation Army wants your money. They'll take it right out of your paycheck. So making that direct gift to a charity is probably the simplest and most straightforward. And especially if you're just giving cash, gives you a great big limit to how much you can deduct to. Of course, if you like, you could even give to a private foundation. Like the Bill and Melinda Gates Foundation, I think will take your money. It's one of the benefits of starting a private foundation. You can have others give to your cause as well. And remember that they don't really have their own cause. They have, they're kind of a pass-through. Anyways, so forming your own private foundation is a more expensive option. And this is what people do when they want control and a little bit of prestige. It's kind of a fancy approach. And also maybe even to put some of their family members to work. All sorts of rules around whether or not you can just hire your deadbeat cousin to work in your foundation. You can if your deadbeat cousin actually has some skills that your foundation can employ. So beyond the private foundation and direct gifts to charity, we almost forgot the bargain sale. That's another way to give to a charity. We talked about that in a previous video. So the next three, the pooled income fund, donor advised funds, and charitable annuities, are also a big part of the charitable giving landscape. In fact, pooled income funds and donor advised funds have exploded because you've got a number of investment companies that want in on this charitable giving action. The difference between a donor advised fund and a pooled income fund is this. If your client wants to make a charitable contribution, they're feeling charitable, but they also can't afford to just straight up make that gift. They still need some of the income, or they need some of that asset in order to make their own personal financial plan work. Well, they could consider a pooled income fund where they would give an amount to this pooled income fund, which might be run by a charity directly, or it could be run by a Vanguard or Fidelity, which technically it's not really Fidelity or Vanguard. It's their charitable versions. They've set up their own public charities in order to participate and offer these donor advised funds and these pooled income funds. They serve a lot of different underlying charities. Let's face it, they're serving themselves because they really want to manage that money. Because Vanguard, Fidelity, Schwab, all these big investment companies that have gotten into this game for both pooled income fund and on a much bigger scale, donor advised funds, these investment companies are making a fortune because the charitable contributions that come into these organizations get invested in the funds of that investment company, whether it's Fidelity's version of it, Vanguard's version of it. When you make a contribution to a pooled income fund at Vanguard, Fidelity, or any of these other big investment firms, that money gets deposited into their own investments. So as you know, there are expense ratios associated with these underlying investments, which benefits the investment company. So keep that in mind. There are some downsides to using pooled income funds, however, and that's that you lose control of that asset. Once you donate that asset to this pooled income fund, you have no more control over it. You do get some income for the rest of your life, and it's based on how big of a contribution you made to that fund. So your actual deduction is going to be reduced based on the calculation of what value you received in exchange for that contribution. And it's sort of based on an actuarial calculation for how long you're going to live. The pooled income fund is good for small donors who can't really form their own CRUT, or who just want to make a contribution and still get a little bit of income from it. All right, so that is a part of the business, but the much bigger business is donor advised funds. And donor advised funds are a lot like giving just straight up to a charity. But here's the problem that some people face. They receive a windfall in one tax year. For example, one of my clients is a radiologist and just sold out to a private equity firm. He wasn't happy about it, but his partners wanted to do it. And he received just shy of $3 million for his share of the radiology practice. He's still working as a radiology in this practice, but now he's not an owner the same way he was before, blah, blah, blah. And he's always been charitable. This is a key component. You have to already be charitably minded in order for a charitable contribution to make sense. You would never make a charitable contribution only for the tax savings. Obviously, you've got to give that thing up to get the tax savings. So unless you were going to give to charity anyways, don't do it. In this case, my client is charitable and was planning to make charitable gifts for the rest of his life. However, now that he's got this windfall, we looked at making all of his lifetime charitable contributions in 1 year. And he's like, but who would I want to give all of this money to? I don't have any one charity that I'm interested in, and I want to take my time and think about it. Bing, 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 bing. That's what a donor advised fund is for. Donor advised funds typically formed by, again, the biggest ones are Fidelity and Vanguard. So if you go to Fidelity Charitable or Vanguard Charitable, you will find some of the best information about donor advised funds. They need to make it clear because they want people to use their charitable arm to make their donor advised fund contribution. Making big contributions to donor advised funds is appealing because you get an immediate tax deduction for your contribution. There is a limit to how much you can deduct in any 1 year. If you make a cash contribution, 60% of your adjusted gross income. If you donate appreciated securities, 30% of your adjusted gross income. If you go over that, you can carry it forward in future years. And the big benefit is no need to rush with grant making because you make this contribution to a donor advised fund, it's gone. You can't withdraw it to pay for your kids' braces or college or whatever. But you get this sense that you have some control. You don't, but you get the sense that you have some control because you can pick which underlying investment fund you want it to be in. And you can also select the people or the organizations, the charitable organizations you want to make grants to over a long period of time. What happens is a lot of people sit on these accounts forever because they sort of think of it as their own money. They like to see it grow. And of course, the Fidelities, the Vanguards, and the Schwabs of the world don't care because the longer you keep your money inside this donor advised fund, the longer they can charge their investment fees. So there are some problems with the structure, just in large terms. There's some issues. However, it's a wonderful tool for people like my client who needed to make a big giant contribution, wanted the deduction, but didn't want the pressure of picking who they wanted to make grants to. You can do it over time, and then you can also name a successor, a grantor. And if you wanted to, let's say at the end of year 2, you're like, guess what? I'm giving all my money to United Way. Poof, go ahead, knock yourself out. You can do it all at once, or you can drag it out over a long period of time. The biggest approach, or let me just say. So giving cash gives you this big limit, but giving appreciated securities, yeah, it's a smaller limit, but man, can this be a smart move. So going back to my client who received this big payout for his radiology practice, he also had a large taxable portfolio of individual mutual funds and ETFs, highly appreciated. So instead of giving cash, we gave these highly appreciated shares of mutual funds and ETFs to the donor advised fund. You can transfer assets in kind, which means you get the full credit for the appreciation So the appreciated value of these securities is what you get credit for. However, had you sold them before making that gift, you would have incurred capital gains tax. And for my client, his capital gains tax would have been over 20%. So it just makes good sense for clients in high tax brackets to look at giving appreciated securities. The downside of donor advised funds, you cannot use them to make a qualified charitable distribution. And just a quick word about those. A qualified charitable distribution is a lovely tool. When you turn, now it's 72 years old, it used to be 70. So at 72 years old, you are required to take minimum distributions from your tax qualified accounts. So all of your pre-tax savings, 401ks, traditional IRAs, all of those require distributions be pushed towards you beginning at age 72. That just changed. It was 70. Your required minimum distributions from your tax qualified accounts show up to you as taxable income for both federal and state purposes. Taxable at normal income tax rates, which means it's expensive, which is sad. However, here's a deal that the IRS is offering. You can take up to $100,000 of that required minimum distribution, and instead of you receiving it, you can push it directly to a charity. And that way it never even hits your taxable income. So it doesn't even hit your tax returns. You don't have to worry about itemized deductions. You'll just take the standard deduction and enjoy that high limit. So these qualified charitable distributions need to come from your required minimum distributions in order to make this work. And it has to go to an operating charity. It can't go to a donor advised fund, which is really sad. So that's the donor advised fund. Charitable annuity is essentially just a charity trying to get in on this action. They're like, look, you want to help us? We want to help you. Give us your money. We'll give you a guaranteed annuity payment. Hopefully they're good for it. And we'll agree on the term of the annuity income. And then when you die, we obviously we keep the principal and we put it to good use. So you don't usually get as good of a rate from a charity who's offering you an annuity as you could from an insurance company, but they're like, hey, don't you feel better that you gave it to us instead of giving the profit to an insurance company? Maybe, maybe not. So now let's go to the bigger kahunas, the setting your own charitable trusts up. And this is where we talked about the CRAT, the CRUT, the CLAT, and the CLUT. I'm sorry this got so smudged. I should have made it cleaner. I totally could improve this drawing. I will improve this drawing. Anyways, so when you set up your own charitable trust, you're doing this because you're like, hey, I want to control this investment. So like a private foundation, you do that because you want to control. But unlike a private foundation, you're saying, I still want some benefit from these assets over and above that charitable deduction. I either want to get income from this asset for the rest of my life and I'll give the charity the remainder, but I'm going to take that charitable deduction now. There's fancy math that gets done on how much of a deduction you get. Or I'll want to give the charity income now, and then I want to decide who is going to get the asset after I'm gone. So whether it's charitable remainder versus charitable lead, notice that charitable is in both of those phrases. So when you see charitable remainder, think the charity gets the remainder. When you see charitable lead, think charity gets the lead income. So the first thing that happens is income gets spat out, and that's what the charity gets. So charitable remainder trusts can either be a charitable remainder annuity trust, meaning that you get annuity income as the donor and the charity gets what remains at the end of the trust term. And with a charitable lead annuity trust, that means the charity gets the income in the form of an annuity, and you get the, or not you, your non-charitable beneficiary gets the remainder. Versus the CRUT, the charity receives the corpus at the end of the trust term, you get the income, but that income is a percentage of the trust assets, versus the CLUT, where the charity gets the income and you get the remainder, or rather your beneficiary gets the remainder. So remainder versus lead is really referring to the charity and what's their relationship to this trust. Are they getting the remainder or are they getting the income? And then we've got a percentage of the trust assets being spat out as income, or a flat annuity payment being spat out. So when you think about a flat annuity payment being spat out, you understand that some years when your investment doesn't do good, but we're still hammering out those flat annual payments, then you could be eating into the corpus, which is maybe one of the downsides. So let's look at some of the details here. So the annuity can be determined initially. You're going to pick a flat annuity amount that needs to be between 5 and 50% of the initial fair market value of the asset that gets contributed to that trust. That's what determines that fixed annual dollar amount. Once that's set, though, it's done, which means you may have to evade the principal to make that payment, which is not attractive. The term of the annuity can be fixed or it can be for life. So if you're going to do a fixed number of years, it's 20 years max. So with the unit trust, you set a fixed percentage, and then every year that percentage comes out of the trust. And so you got to do a recalculation each year of the fair market value of the trust, and you can add to it. You can add assets to the trust because you're always doing a percentage of the assets. Payments can be limited to the income earned. And if you do that, it's called a CRUT. And like I said, you can put more into it. So because of the some of the features of this unit trust, you get inflation protection. And the downside is annual recalculations, a pain in the butt. That's just an overview of all of the different ways that you can be charitable.